Today's class will cover the plan data for Total Online. As we go through the different data entry points, you'll be able to see the detail and flexibility available in Total Online. So we'll go ahead and move to the program. And you can see I've logged into Total Online. I'm going to go ahead and select a client, open up that client, and then in this case I have two different planning scenarios created for this client. I'm going to choose one of these scenarios here. And then once I have a scenario open, you'll see the different plan data sections. So this is going to be all the information that's going to be required to create the financial plan for the client. So you'll notice the different sections on the left-hand side, starting with assumptions and ending with Monte Carlo. So we'll have to go through all these data input points, and then from there, you can generate the reports. So today's class is going to focus on this plan data section. So we'll go through each one of these data input topics. Starting off with the assumptions section, and the first tab here is scenario. We're going to be providing some information about this plan. So the scenario name is so you can distinguish which scenario is which by naming the scenario something descriptive. You do have the option of the scenario name being included on the reports as well. Also some basic information here for scenario ages, like the retirement ages and life expectancies. Life expectancies will be populated by default using the IRS uniform lifetime tables, providing the longest life expectancies. If you want to override that, simply highlight the value and enter in your own life expectancy to use instead. Below scenario information, we have cover page information that will be used just for the cover page of the reports. So the client's name for the cover, the date that you want to have display on the cover page of the reports. There's Easy Money and Golden Year's title. If you leave these blank, the program will pull the default title from your settings section. If you want to use a custom title, go ahead and enter it here and it will be used for the cover page report. Also, there's a page header. This allows you to have a page header display on every single report page. So not only the cover, every additional page will also display this page header line. Typically, that line is used for required disclaimers or disclosures. To the right, we have cover page lines. This is going to be where you're entering in your contact information that shows up on the cover page. For example, here we have a company name, an address, phone number, website information. This information can be pre-populated in the program settings as well, so you don't have to enter it in each time. Throughout the data input, you'll also notice this notes section, so you can record any notes that you need to. These will not display on the reports, just a place for you internally to keep notes of anything that you would like to record. So once we move through scenario, we can go to the default rate section. Everything else in this settings section, in this assumption section, is pre-populated from the settings. So there's a separate video that will cover the settings section. So settings are typically going to be populated with your most commonly used case, and then you can just go through the different tabs in this section to make sure they apply specifically to the case that you're working on. We'll go ahead and cover these items in today's videos, but they'll also be covered in more details in the settings video. So default rates, this is an important one to understand and learn. The first section here is the rates of return. So you'll notice we have taxable, equity, tax-free, tax-deferred, retirement accounts, and then a checkbox override at retirement. We have some options with rates of return. If you're entering in your assets and you're choosing to just leave all the rates of return blank for the individual assets that you're entering, that's when the program will look to the default rates that you've entered here. And so it would pick up the current rates of return. If you check this box, override at retirement, it will change to use the return under the retirement column. This checkbox is particularly important because even if you've entered in rates for the individual assets, this is going to tell the program to override the rates that we've entered in the individual assets and switch to the rates that we've set here for retirement. So that checkbox can have consequences. Make sure you pay attention. If you are entering your rates of return for individual assets and you do not want to change the rates of return at retirement, simply leave this box unchecked. And the next section here we have is other rates, so some additional items that can be set up in the program assumptions. discount rate for net present value calculations. Typically, planners are entering in something like a conservative after-tax return, kind of figuring out if they had that money today and they could earn this rate in the future, would they be able to cover future shortfalls, for example, or life insurance? Would it be enough life insurance if they had that value come into them today? It's using it to discount those future values back into today's dollars. So kind of figuring out how much they would need today to cover those future needs. And then there's additionally shortage solutions. So if the clients are running out of money in the retirement situation, the program is going to come up with shortage solutions for them. One of those solutions is going to be making additional savings. And if they were to make additional savings and increase their deposits, we would need to know what kind of deposit would be required if they were to earn these 3 different rates of return. So of course, if they were earning a higher rate of return, their monthly deposit wouldn't be as much or as high as if they were earning a low rate of return on that additional funds that they were able to set aside and save. So the next tab along the top is surplus allocation. If there's a cash flow surplus, the program wants to know what should it do with that surplus. So you can allocate that surplus. It could go 100% into their regular taxable savings. It could be broken up across the categories. All you need to do is enter in the percentage of how you want that surplus to be saved and allocated into their savings. And you have the opportunity to change it at an age in the future. Simply enter in the age you would like to change how that surplus is treated and the corresponding allocation percentages. Next, we have a pre-retirement cash flow section, which only applies to golden years. And that's one of the basic differences between Easy Money and golden years is how the pre-retirement cash flow situation is handled. Easy Money ignores the regular day-to-day income and expenses prior to retirement, whereas golden years is going to pay careful attention to every cash flow inflow or outflow from pre-retirement years and on. So if you choose, you can make golden years work a little bit more like Easy Money by checking this box, do not reinvest pre-retirement cash flows. That's going to make it work like Easy Money, where that pre-retirement period, the regular cash flow shortages and surpluses are ignored. Also, I'll point out here, help is a great resource. So as you go through the programs and can't remember exactly what one of these fields means, you can go up to help. The first item listed here will be the help to the particular item that you're working on, and it will give you a good description of everything. So help is just a click away here. Next tab is other. Here's more options for them, retirement plan options. If they're in a situation where they're still working and they're able to delay RMDs for their qualified plans, employee-sponsored plans, you can enter in the age that you would want to delay their RMDs until. Situations like penalties on pre-59.5 plan distributions, for example, if they're doing a Roth conversion and they wouldn't have to pay a penalty, we could uncheck that box. Some additional items here, like including retirement plans and asset allocation mix, asset pyramid, and liquidity reports can be selected. That's going to allow you to either mingle retirement accounts into those specific report pages that are listed there and have them be available to be reallocated, for example, in the asset allocation mix, or if you want to keep retirement plans separate and out of those particular pages, you can uncheck that box. Next section is tax favored investing. This is a single report page available in Easy Money, and it will display the results of using investments with different tax treatment to show how an initial investment and annual additions would change based on the tax treatment and the rates of return that you're setting up here. The last tab we have in this section is report options. So you can choose a date for their net worth if you want it to be something specific. There's a wonderful report page called Future Detailed Cash Flow. By default, the program is going to provide a current year cash flow and then give you a line-by-line list of all their inflows and expenses for a particular age in the future. So you can change that age to something other than the default, which is their retirement age, by entering it here. Net worth style, we have multiple styles of net worth. So if you run the reports, you'll want to take a look at these different styles and see which one works best for you. Same with sort asset details by. It's going to list all the client's assets and you can just have it sorted in the order that you choose. So description is going to be alphabetical based on the name of the asset, or you could group them by owner, liquidity, class, type, group, whatever you choose. There's some formatting options, so justifications for items like their cover page or title. They can either be center justified or left justified. You also have the ability to adjust the font that's used for the report, as well as the color for the headings. So you can have a preview here. You can see the list of the different fonts and how that changes on the preview. Okay, so that's everything for the assumptions section. And again, mainly you're just going to be reviewing this information since it will be pre-populated from your default settings. Once you are through assumptions, you can move on down to assets. And assets is going to be where you're spending a little time entering in their asset data. You can take a look at the tabs available at the top. The first tab is the asset section. So this is going to be where we're entering in all of their assets, whether it's rental real estate, personal property, retirement accounts, everything's going to be in this single section. So as I click on one of these assets, you can see that the data input will open up below and we can see the different options. This interface will change as you choose different types of assets. So if I were to change this from a checking account to rental real estate, for example, the interface would change to collect the information that we need for the type of asset that we've selected. We do have the ability to copy an existing asset. So if you have one asset that's very similar, you can quickly copy it and just change the variables. That's a time saver for you. And we have some additional options here. Asset classes, for example. This is another item that's pre-populated from your settings section. So where we have the asset classes of reserves, income, these items can be customized for a particular scenario here. And they can be customized for all your scenarios as your default settings. So if you want to use something like small cap, mid cap, growth, value, whatever you're using in your planning practice, that can be fully customized. So when we take a look at the data input for an asset, I'm going to go ahead and choose a different asset here. I'll look at a 401k, for example. We'll take a look at the data input items down below. And you can see the name. Of course, you're going to be supplying the description of the asset. The group is a long list of groups available, and you need to just choose whatever's closest for this asset. The type. This is going to be where you're choosing whether it's taxable, equity and other, tax-free, tax-deferred, or retirement plan. And this type is going to play a big role in the projections. The program groups the assets by their taxation type. So all taxable accounts get pooled in one pot and projected going forward. Equity and other, same thing, get separated in their own pot, tax-free, tax-deferred, and retirement accounts. Sometimes we get questions on the differences between these types. Taxable is going to be anything that's earning purely ordinary interest, so something like a checking account, savings account, CD are going to go under the category of taxable. And that's distinguished from equity and other, which is something like stocks, mutual funds, something that's earning a blended return. So some of the return could be interest, some of it could be dividends, some could be capital gains, some could be appreciation. So that's going to be the distinction between taxable and equity. Tax-free would be any non-qualified tax-free accounts. So muni bond fund, for example. Tax-deferred would be any non-qualified tax-deferred accounts like an annuity. And then lastly, retirement accounts will give you different options here. So things like 401ks, IRAs, Roths will all be available once you choose retirement plan. After you have the type set, then you choose the owner of the asset. And then you have an additional option for retirement account specifically, which is project this retirement plan separately. That can be very helpful if the clients have multiple retirement plans and they don't want them grouped together. So if we wanted to keep Susan's 401k on its own particular asset page and it would be tracked separately from any other retirement account she might have, we can check that box. And you can check this for up to 6 different retirement plans. To the right, we have information that's optional. So left-hand side, you definitely need to populate. Right-hand side can provide additional information that's used for some particular report pages. So accounts is optional, but this is a matter of how you choose to enter your information in the asset section. You'll notice we entered Susan's 401k as a total asset of $93,500. You can also enter in that as an account. So we could create an account called Susan's 401k and then enter in the asset section the individual holdings that make up her 401k and tie them to this account called Susan's 401k. So that would be another option for you. Entering in the individual holdings can be useful for certain report pages like asset allocation and asset details. So it's up to you. But definitely entering in an account level will be a time saver for you. So class is where we were looking earlier at the asset class item. This is going to be used for the asset allocation reports. Again, the classes that you see here are fully customizable. You can have up to 21 total asset classes. The class that you select will be used simply for the asset allocation report pages. Liquidity, another item that is going to be used for a specific set of reports for the liquidity analysis pages. Beneficiary is also optional. This is used for the estate planning reports only. Stock symbol is something that can be used to grab the current price of a stock. So if we were entering in an asset that was a holding in Apple, for example, we could give it a name of Apple stock, enter in the appropriate group and type and owner, and then we could tie it to a stock symbol here by clicking tie to stock symbol, enter in the stock symbol, hit OK. In this case, I'm going to hit cancel. And then we could click on the stock prices to choose to update the stock price. So any of these assets that are tied to a stock symbol will go ahead and go out to the market and grab the latest price for that symbol, which would be populated here. Particularly if we have the number of shares and price per share, that price per share is what would be updated if we tied an asset to a particular stock symbol. In this case, this is a general retirement account, so we're not tying it into anything specific, and we're not looking at price per share and number of shares. We just want to enter in a total value in this case. To the right, we have rate of return, so we can say this is earning a 6% rate of return. This is what we want to project this retirement account going forward. And since I've entered the rate of return in this section, then the program will use the rates that I've entered here instead of using what we saw under their assumptions and default rates. It would only use the rates from the default rates tab if you weren't entering in the rates for the individual assets, unless you're checking this box to change the rates and overwrite them at retirement. So if I go back to my assets here, we'll go back to Susan's 401k. Since this is a retirement account, we will look at the pre-retirement addition section, and it's a retirement account, so we do have personal contributions that can be made as well as company contributions. In this case, we can do a dollar amount with an increase rate or tie it to the client's salary. So in this case, Susan's putting away 8% of her salary into this 401k, and her company is putting away 6% of her salary. The next item we have is the future changes. This gives you a lot of flexibility, and this is going to be something you'll see throughout the data input for Total Online. And these allow you to stop, start, or adjust these items at any age in the future. So if we had entered in pre-retirement additions in the fields up above, perfect. Let's take a quick look at that again. The default behavior would be putting away these percentages from now until the client's retirement age. Future changes allows us to change that at any point in the future. So in this case, at 62, we're going to say that Susan is going to actually ramp up her savings. So instead of saving 8% of her salary, she's going to change and start saving 10% of her salary. Her company will still be saving 6%. At 65, by entering age 0, that ensures the contribution will stop. We can also do withdrawals in this section. So if we wanted to say that she's going to start taking withdrawals out of this account when she retires or at some age in the future, we can say, okay, she wants to pull out a specific dollar amount from this 401k. So you can enter withdrawals in this section as well. So it gives you a lot of flexibility. We'll take a look at some of the other assets available here. Inherited IRAs, for example, is one. You'll see the different data input points as it changes to collect the inherited IRA information. Something like a house or residence. Take a look here. So this would allow us to quickly sell the residence at any point in the future, as well as enter in replacement home information. So it will make the process of selling a home and replacing a home very quick and easy. This can also be used for future residence purchases. On the residence front, we do have rental real estate as well. So if they have any rental properties, the user interface, if we choose the group of rental real estate, will change to collect all the purchase information, cost basis information, income and expenses associated with the rental, and allow you to sell that rental at some point in the future as well. So we'll track everything it needs for the cash flow of a rental property as well as the tax implications of a rental. See, stock options is one that the user interface will change as well. So if they do have any stock options, we can enter in the grant information and then the future vesting and sales of these stock options. So it can capture, again, the tax and cash flow effects of selling and exercising stock options in the future. So it's a really robust user interface, handles many different asset types with a lot of flexibility for you. So once we have all that done, we can see in this case they have a total of 29 assets. It's nice to have a quick summary here. 1.2 million, almost 1.3 million of current assets. We can also see this on a summary report, and those are available throughout the user interface as well. Once we complete that asset section, we can move on to retirement plan additions. So you'll notice for the 401k, we had entered in that she was putting away 8%, her company was putting away 6%. This is a way that you can quickly maximize an addition. So if we knew that Susan was maximizing her 401k every year and we wanted it just to increase as the allowances change over time, we can just click that button and say, great, the program's going to handle maximizing her 401k. So you can do it for a retirement plan as well as a Roth. So if they're both maximizing additions to the Roth, perfect, just check this box. It will take care of that piece for you automatically without having to enter in the asset section. One thing to be mindful of though, if you do both, the program will allow both, so that can trick people every once in a while. So if you're entering in that they're maximizing their 401k plus you have additions entered in the asset section, it will double count the additions. So that's when you would want to take a look at this view addition, so you can take a look at everything that's been entered in the first tab in the asset section, which in this case we can see the contributions being made to their IRA, as well as any contributions that are set up as percentages of salary. So the next tab is allocation. There's a risk tolerance test, and there's a financial attitudes questionnaire, and an asset allocation piece. This will be used for those particular pages on the reports available in both Easy Money and Golden Years. For the asset allocation, it's going to display a simple asset allocation report showing how the clients are currently allocated versus the suggested allocation. You'll notice suggested is all 0 here. If it's 0, the program will look at the risk tolerance level to pull from the settings that you have for the asset classes. But if you want to use something specific, you can enter in suggested percentages here, and it will overwrite any of the defaults that you have. Next tab we have is rate changes. So this is one other place that you can actually change the rates of return that are used for the assets in a future age. So we saw under assumptions and default rates where we could check the box to override the rates of return at retirement. This gives you some more flexibility where you can change the rates of return for any of the taxation types at any point. So if we click on taxable, for example, there's a future changes table that allows us to change the rate of return using that age change type table. So at age 70, for example, we're going to change the rates of return on their taxable accounts, which again are like checking, savings, CDs, things like that, from the current rate of 3.31 to 2.5%. So we could click on add entry to add additional rows if we wanted to continue to make changes in that table. The second option you'll notice is this cash payout box, and that allows the program to specify that interest, dividends, and capital gains are taken in cash. So with that box unchecked, the default behavior is for those items to just simply be reinvested into their accounts. But if the clients are using those, they're living off of them, considered an income source for spending, you can check that box and instead those will show up as an income source rather than the default, which is just to turn around and reinvest them. Okay, so the last tab here is accounts. So once again, when we talked about the data input on the first tab where we entered in Susan's 401k as a single asset, if we chose instead to enter it as an account, this will just provide you a place where you can easily see the accounts that are entered and all the assets that have been connected to that account. So that's everything for the asset section. We'll go ahead and keep on going, and the next data input section is liabilities. So liabilities is going to be really straightforward. You'll have a good feeling for how the user interface works after you get through the asset section, of course. So when you click on one of these liabilities, we can see the information that's going to be entered, the name of the liability or description, the type, so whether it's a mortgage or a personal loan, whatever you choose there. So in this case, it's a residence mortgage, so there's going to be an additional field allowing us to tie this mortgage to an asset. So in this case, it will look at the assets available on the residence assets available that have been entered in the asset section. So in this case, there's only been one. The advantage of tying liability to an asset is if you do use that future sale feature in the asset section, it ensures that the liability is paid off at the same time as the home is sold. So that's how you associate a liability with that asset that will be sold to ensure that that balance of the loan is also paid off. So for the liability information, you need the current balance, the monthly payment, and the interest rate. From those three variables, the program will amortize the loans, and it will give you a preview of how long it will take for that loan to get paid off. So it would continue their monthly payment from now until that loan is paid off. At that point, it would drop that expense. And let's see here, we do have some more details that can be entered for liabilities. These are, again, optional items that don't have to be entered, but you can specify when it was opened, the original balance, if they're going to be making a balloon payoff at a certain point. So for example, if they were going to pay off this loan, but they weren't going to sell their residence, but they wanted to pay it off next year, for example, you could enter in that balloon payoff age, and that lump sum of the loan would be paid off and included in the projections as an expense at that point. Additional items like who it's owed to, who it's owned by, and payoff at death is used for the insurance reports available in Easy Money, which looks at, of course, the life insurance needs analysis, so you can choose to include an assumption that these liabilities will be paid off at death or not, using the options here. Okay, so once we have our liabilities entered, we can move on to income. Income is going to collect their earned income, Social Security, pensions, so kind of income streams coming into the client, as well as other income, which is going to handle miscellaneous items that don't necessarily fit in those first three tabs. So starting off, we have earned income. This is going to be pretty straightforward as well. So we have Susan and David's earned income. They can have salary and wages and self-employment type income. So you can simply change it by clicking up above, and then you're just going to be entering in the annual amount that this individual is earning and the assumed increase rate for those earnings. You'll notice we do have this checkbox, enter amount details. If I check this box, the user interface will expand to give us some more categories here. Typically, these items are going to be the same and you won't need to use this amount details, but it does give you flexibility if you need to report different amounts on different report pages. An example would be for the survivor reports in Easy Money. If Susan was in a survivor situation and David were to die, if we needed to adjust her income, we could. So they have dependent children, a situation like that, for example. Maybe she would have to work a little less and stay home and help take care of the kids a little bit more, and we would want to reflect that her salary would be lower in a survivor situation. So it's there to give you flexibility when you need it. Again, we have the future change table. So here's some entry points that have been added. This is actually looking at increasing her salary this year, since she's currently age 60, to $75,000. And then again, expecting an increase at age 62 to $80,000, and then stopping her income at retirement age at 65. So again, if you didn't use any future changes, this income would just continue from now until her retirement age, increasing at 3% each year. If you do use the future changes table, the program will look to this information, and if we didn't enter in a stop age, it would assume that this income at age 62 of $80,000 would just continue on. So it doesn't look at the pre and post-retirement periods any longer. So you need to make sure you enter in a stop age when you are using these future change tables. If we were to say she's going to retire at 65, but then she's going to do some part-time work, for example, and she's going to earn $20,000 a year until age 75, we could stop it at that point. So simply enter in the age to stop and zeros to stop any of these future change tables. So I'm going to set that back to 0. Moving on to Social Security. You can enter in the increase rate you would like to assume for Social Security benefits. The percentage taxable for easy money, typically it's going to be 85%. Golden years will actually do the full calculation to determine how much of their Social Security is taxable each year. For easy money, you do need to make an assumption for the taxation, and again, to be more conservative, I would recommend using 85% unless that's clearly not the case for the client plan that you're working on. For each client, you can check if they're not qualified to receive Social Security. Percentage of Social Security benefit to show on reports, you can actually, in this case, we have it 85%, so it's slightly lower. Typically you would have that 100%, but if somebody doesn't want to rely on Social Security, or they don't expect as much to be available to them as their statement shows, you could be conservative there and say, well, let's just assume you guys get half your Social Security rather than the 100% expected benefit now. You can use that field for that. And then again, we have this enter amount details to open up the different types of reports that the information is used on. But your typical case, you're going to have that box unchecked. You would simply enter in the start age for Social Security and the monthly dollar amount. If you don't have the estimated benefit for the client, you can leave this 0, and the program will look to the earned income that you've entered here and use that to estimate their Social Security benefits. Again, future changes. So if you need to do any Social Security strategies, you can use these age change tables to adjust the amounts at any point in time. So for pensions, if they have a defined pension benefit, it's going to go here. We have a spot for 2 pensions per individual. So in this case, David has a pension. It's starting at $67, $2,000 a month, increasing at 2%. You can also do an increased dollar amount instead. And if it were to be state or federally tax exempt, we have boxes to handle that. Just simply check the box to keep keep state or federal taxes from touching that pension. Then we have a place down below for entering in any survivor benefit associated with that pension. So this case, we have a 50% survivor benefit on David's pension, and there's an additional field that looks at if death were to occur today. So this first field is for the retirement projections of, okay, well, when David dies at his life expectancy at age 90, and Susan has a couple more years to live, she would get half the benefit at that point. But the second field here is for the survivor needs analysis, again, in easy money only, it says, as indicated here, which look at if death were to occur prior to retirement, or today even, what kind of pension benefit would be available to the survivor. Once again, a future change table to give you more flexibility to change those amounts at any point as you need to. The last tab we have in the income section is other income. So this is going to be useful for items that don't necessarily fit under the first tabs. For example, we have sale of equipment, or if somebody was expecting an inheritance in the future, they could be entered in this other income section. So simply give it a description, the amount that you're expecting, an increase rate, the start age for this item, and then if it's going to increase prior to start age or after start age, simply check that box. And then you can provide more details as well. If it's a recurring item, for example, if this is something that's going to come in for a 5-year period, for example, we could say, yes, it's reoccurring every age until, let's see, it's starting at 59, so that one's actually, let's change it to 60, her current age. So if we were going to say it was going to come in every year until age 65, we would get a 5-year income stream of $25,000. If it's taxable, we can enter in the percentage subject to taxes. And then there's fields for survivor reports. So if it's something that wouldn't be available to a spouse in a survivor situation, you can adjust the amount there. Again, we have future changes to stop and start and adjust that amount as we need to. The next input section is insurance. So we can see here we can enter in life insurance, miscellaneous, and disability long-term care. So life insurance, as we click on one of these items here, and you can see the information that's going to be entered. It's going to be the description, the type of policy, company, which is optional, who's the insured, who's the beneficiary, who's the owner. And then we get into the policy values. One thing to point out here, particularly for term policies, are the 2 columns, current and retirement. So if it's something like a term policy that goes from now until retirement age, perfect. All you need to do is enter in the premium and face amount in this current column and leave it blank for retirement. So that would stop the policy at the retirement age. If it's something like a whole life policy that would continue into retirement, make sure you fill out the retirement column as well so that the program knows that this policy is continuing into retirement. If you were to leave these all 0, it would assume it would stop. Once again, for something specific, like a 5-year term policy, we do have the future change table, so you can adjust that amount at any point and stop it after that 5-year term, if that were to happen prior to retirement, for example. So let's see, a couple things I didn't talk about here. Suppress life insurance on the retirement reports. If you wanted to just simply keep life insurance death benefits out of the projection, you can check those boxes. And the second item is to include the cash values in the asset allocation and liquidity report. So you can keep them out, or you can choose to include them by checking the box. Miscellaneous insurance is going to be really straightforward. So if they have things like premiums that they're paying on their auto policies, disability policies, long-term care policies, they're all going to be entered in this section simply by giving it a description, choosing the type, who's the insured, the premium, and the inflation rate. Again, future change table available if you need it. The last tab, disability long-term care. This is used for a specific set of reports available in Easy Money because it has the insurance projections, which looks at their need for disability coverage. If they're short, it's going to explore their disability situation, what kind of benefits are available to them now, what kind of income sources would they have from the spouse that was not disabled, what kind of expenses they would have in a disability situation. And it's also going to include a long-term care report, which looks at the total cost of care, and you can actually adjust the number of months assumed care for those projections, as well as the cost and increase rate. Once we're through with insurance, we have to move on to the tax section. And the first tab here is going to be collecting some important information. So this first field we get quite a few questions on. Increase rate for federal tax tables and exemptions. That's going to be how much do you think that the tax brackets and exemption amounts are actually going to go up over time. So typically this is going to be a rate close to inflation, because typically they'll adjust the tax brackets with inflation over time. They'll adjust the personal exemptions, for example, over time, matching the cost of living increase. The next field, tax filing status, that's pretty straightforward for you. Number of exemptions, if they have any over 64 or blind, you can pick them up as well. This is used particularly for the Affordable Care Act. So if you need to enter a benchmark premium, there's a particular page on the reports talking about the Affordable Care Act and what the premium might be. Next, we have the state tax information. So you can enter in the state for tax purposes now with the ability to change the state at any age in the future. Simply enter in the age and the state that they would want to change to at that point. FICA taxes, if they were exempt from paying FICA, we can simply check that box to keep it from the projections. Other adjustments gives you some inputs for things like alimony or self-employed medical insurance premiums that can be useful for the tax information. The last item is tax rate override, easy money only. So this is one of the differences between easy money and golden years. Easy money is going to calculate the client's tax rate and use that tax rate throughout the projection. You can choose to override it, so you can change it if you wanted to give them a little break at retirement and lower their tax rate, you can enter it in here. Or if you wanted to override it and not use the calculated rate, you can simply enter it in a before and after retirement value. Golden years, on the other hand, you'll notice there's no fields for that for golden years, because golden years is going to do a full detailed tax calculation every year. So it's not going to calculate a tax rate and apply that tax rate. It's going to go through and actually figure out their tax amount due every year by, figuring out the client's taxable income and running it through the tax brackets. So the next tab is itemized deductions. So since the program is trying to collect all the information for taxes so it can be very accurate in its tax reporting, particularly for golden years, it's going to ask for their itemized deductions so it can be factored in. The itemized deductions that you enter here will be used both as an expense for the client as well as an adjustment for tax purposes. Tax details you're not going to use too commonly, but this allows you to make adjustments to the tax reports. For example, if they had a large Schedule D loss that they were carrying forward from a previous year that the program wouldn't know about, but you would like to have it captured in the reports and carried on going forward, we can enter it here. So if we said they had a large tax loss, it didn't happen in the current year, so we're not going to put anything in the cash flow, because if we put the same $200,000 loss under cash flow, it would actually be an expense that the clients would see in the cash flow report. We're just trying to capture this loss for the tax reporting purposes. We can enter it under simply tax report. We would want to go ahead and enter in their age the following year and 0 to ensure that it was a single year loss, so it didn't see it as a new loss that was occurring each and every year going forward, but it was a loss that had happened previously that we wanted to make sure was carried into our projections. So if you need to make adjustments, just simply enter in a negative value for a negative number, or otherwise it will be a positive value. So you can see the items you can adjust there as you need to. The last item is current year overrides. This tab, typically another tab that you're not typically going to use, this allows you to check a box to override the calculated amount of interest, dividends, capital gains for the projection. So it's going to look at your assets that you've entered and the rates of return and calculate the amount of interest that's going to flow through to their tax report and to their cash flow. But if you said, yeah, I actually really want to match their tax statement that they got me exactly, you could check this box, enter in the amount of interest, and it will use that for the tax report, and optionally you can do the same thing for the cash flow. Once you're through with taxes, we move on to estate and survivor. And this is going to be used for the estate planning reports as well as the life insurance reports available in Easy Money. So we start out with some basic estate assumptions, so things like their administration rates that we would want applied for the estate planning reports. Also credit sheltered funding options, so if you wanted to, by default, it's just going to use separate property to fund a credit shelter trust for the estate planning reports, but you could also choose to use joint and life insurance and retirement accounts, which require some retitling, but you can show it in the illustrations by checking those boxes. Estate strategies allows you just to indicate what kind of strategies that this client already has in place. Next tab is estate gifting. Again, this is used purely for the estate planning reports, but if they wanted to illustrate gifting for those estate planning reports, you can enter the information here and any adjustments that you would need to. There's a particular set of estate planning reports called estate planning options that allows you to evaluate an specific age for their estate planning situation. So by default, it would look at their current age for the estate planning situation, but you can override it here and evaluate a particular age for those estate planning reports. The last tab is survivor assumption. So if they were to die, we're going to allow enough to cover their final expenses, emergency funds. If there's an additional amount of cash needed, you can enter it in here. And so that's going to be used for the estate planning reports as a final expenses item, as well as the life insurance reports available in Easy Money. This field here, amount of capital to be retained at life expectancy. So when it does its life insurance calculations, it's going to ensure that the survivor would have enough to last through life expectancy without running out of money. But if that survivor wanted to be able to pass a certain amount on to their heirs, for example, you could enter in a capital amount to be remaining at life expectancy. So if they wanted to have $500,000 at their life expectancy, the program is going to build up the life insurance needed to ensure not only they could cover their expenses through life expectancy, they would have an additional amount of capital available upon their life expectancy. Okay, so then we have the expense section. So we can see the laundry list of expense items that have been entered here. This is another place that you can choose to kind of keep it quick and easy and just enter in one item for their total expenses and say, okay, they're spending about, in this case, we can see the total is about $30,000 a year, or you can go through and enter in the items individually. The list that you see here is editable so that you can add and delete these categories, but in your default settings, the list is going to be available there. So you can change the default list when you create new plans. It will be populated with what you have from your settings section. So for each one of these expense items, so if we look at food and household expenses as an example, we can see the two, again, typical periods that you see throughout the user interface, the pre-retirement age and post-retirement age, how that expense will change. Again, we have future changes to allow you to change that amount at any point in the future. You'll notice we also have percentages under disability and survivor. So it's going to be how much of this expense would continue on if it was a disability situation, one person became disabled. Same thing with a survivor situation. If one person were to die, how much of this expense would continue on for the survivor? So you can adjust that as you need to. And same with inflation, you can adjust it for those two pre and post-retirement periods. There's a fill rates option, which allows you to quickly change either the increased rates or the survivor disability percentages for every single one of these columns. So if you said, oh, I don't want to use this 3.6% inflation rate anymore, instead of having to go through and change each one, you can use that autofill rates to quickly go in and change all the expense items. So something to point out here is, again, this summary section. And you can see the total expenses. So as we saw here, their pre-retirement expenses were $30,440 and they changed to $29,640 at retirement. But the program is going to include additional expenses based on items that we've entered in other sections. So if we take a look at the summary, this is going to give you a great breakdown of the total expenses. We can see personal expenses amount to that $30,000 that we saw, so everything entered in this worksheet, but we also have things like their mortgage payments, itemized deductions, insurance premiums, education fund deposits that they're making, other debt payments. So we can see that their total expenses actually exceeds that $30,000 that we're entering under personal expenses. When it encompasses all these other categories, we're up to $68,000. So that's their total expenses that's going to be included in the projection. So you do have to be mindful of that. You know, anything that you've entered in other sections, such as a mortgage payment, you will not need to enter in this section, so you won't have to duplicate your effort there. The next tab is other expenses, which matches what we saw under other income, except this is going to be for expenses. In this case, we have a car replacement. So they're going to be replacing a car every 5 years. So they're going to be selling a car, buying a new one. We're just going to enter in the amount that it would cost them. So we're saying it's going to cost them $15,000 to buy this replacement car every year. It's going to increase at 3%. It's going to start at age 65. And then we get into the details where we can say that it is reoccurring every 5 years until age 85. You can make adjustments as you need to. In a survivor situation, for example, we're assuming it would just be half the cost since they would be replacing one car instead of two. So you can see how that will be useful for you. Again, the future changes table available if you need to make any additional adjustments to these expense items. The last tab under expenses is financial goals. So you can see things like a retirement trip and a sailboat have been entered here. This is going to work a lot like an expense that's been entered in other expenses, but you might want to put them in the financial goals section because it highlights the expenses on a particular goal funding report. So it works just like other expenses, except it's going to give you this report that shows them how much they would need to save to achieve this goal. So it's just going to outline the amount of savings that's required to buy this sailboat and take this retirement trip in the future. The next section we have here is education funding. So this is going to be where you're entering in the children and the education cost information. Up above, we have items for the after-tax rate of return you would want to assume on their education funds, the percentage of cost parents plan to pay. This one can be particularly helpful if the clients were exploring different payment strategies. For example, 100% of their college costs, 50% of the children's college costs. You can quickly change the variable of how much the parents would be paying without actually changing in the cost of each college that you've entered in the college costs down below. Any inflation rate you would want to assume, of course, on their education expenses. This checkbox, deduct net cost from assets, can make a big impact on the client's plan. If you have this box unchecked, you'll get the education funding reports that would show the clients how much they would need to save to fund those future education costs, but the cost would not be factored into the client's projection. If we check this box, this is saying, yes, indeed, the parents are going to be paying for these college costs, and any uncovered college costs should be an expense that the parents would have to pull from their assets to pay. So make sure you pay attention to that checkbox, as it will make a pretty big impact as they have to pay for these college costs. So when you are entering in the children, we're going to need their name and their birth date, dependent until age. First year of college, you can click calculate, which is just going to assume that they'll start at age 18. Number of years of college, type of school, annual college cost. We do have a college cost estimator to help you populate that college cost. So we're in Oregon, for example, we can narrow down the colleges and universities by state, and we can take a look at the schools that are available. We're in Corvallis, Oregon, where we have Oregon State University. So you can see what the in-state tuition would be, or out-of-state tuition, or if we were to add in their housing costs, and you can see how that can quickly help you estimate what the potential college could cost. So we're using that Oregon State as a guideline for this client here, assuming that their kids are going to go to state school but still be paying for housing. Then we're going to indicate if there are any funds currently available and if the clients are currently making contributions to these college costs. So they have $17,500 available for Andy now, and they're saving $45 a month. So those will get factored into the education funding reports. The program will also use the funds available before passing any costs on to the parents when you have this deduct net cost from assets box checked. So the last of the data input sections is the Monte Carlo. So you'll notice that the first field is rate of return and it's grayed out, and that's because the program is looking at the rate of return of the entire portfolio, so it's the weighted average rate of return based on the assets that have been entered and the rates of return assigned to those assets. So from there, the program's going to look at the total rate of return and apply a standard deviation. You can click on calculate to have the program calculate one for you, which is going to display what the probable range would be. So 95% of the results will fall between negative 6.71% and a high of 19%. So that's going to be the first two standard deviations. The Monte Carlo will actually go out a full 5 standard deviations. 95% of the results, when it's choosing those variable rates of return, will fall within the first 2 standard deviations. Make sure that the range that you see here is what you're comfortable with. You can increase it by entering in a higher standard deviation, or decrease it with a lower standard deviation. You do have the option to use a fat tail as well, so if you want to be more conservative and introduce more extreme negative type events, you can check that box and it will impact your Monte Carlo to make it more conservative. You also have the ability to choose to vary inflation. So by default, I think this is set to 0, so it would assume inflation stays steady over time, but you can choose to apply a standard deviation there as well. and it would vary the inflation rate that's applied to your expenses every year for those 10,000 different simulations it would run for the Monte Carlo report. Once you get through with Monte Carlo, you are ready to run the report. So everything that you've entered will all come together in the financial planning report that you're choosing to generate. So this is where you can choose to run either Easy Money or Golden Years reports. And we'll talk more about the reports in a separate video. That is everything that I wanted to cover for the data input class. It's a pretty detailed class, so thank you very much for taking the time to watch this video. And as you have questions, of course, go ahead and contact our support team. Our support team is available by calling 877-421-9815. It's extension 0 for support, or simply email support@moneytree.com if you do need any assistance. And so the support team is available weekdays from 6:30 a.m. to 5, and we are Pacific time, so call us within those hours and we'll be able to help with any questions that you have. So whether it's entering something specific on the data input or tracking something down on the reports, feel free to please call our support team and get assistance. Again, thank you very much for watching this video today.